If you want to make investments that grow entirely tax-free, choosing a Roth account is one of the smartest money moves you can make. But many people get confused about whether a Roth is right for them or which type of Roth to choose. Did you know that different types of Roth accounts have different rules? Well, this episode is going to break it down. We'll talk about 8 crucial differences between a workplace Roth and a Roth IRA or individual retirement account. I'll explain the rules, how to prioritize your contributions, avoid mistakes, and stretch your tax-free retirement dollars as far as possible. So whether you're just starting your career or you're getting close to retirement, don't miss this show. Hey everyone, welcome back to episode 1045 of Money Girl. I'm Laura Adams, an award-winning author, a media spokesperson, and money speaker, and of course the host of this show with over 44 million downloads. In the show notes, you can find links to learn more about me, submit your money question, and sign up for my free newsletter, The Money Stack. When you sign up, you automatically get my free money success toolkit, and it includes a personal financial statement template that's one of the most suggested forms and tools that I recommend for managing money. So I hope you will sign up for the Money Stack and enjoy that free gift. All right, let's start with a question that can trip up a lot of people. Should I use a traditional or a Roth retirement account? Both types are excellent ways to build a retirement nest egg, but they have very different rules and different advantages that we'll cover. So let's start with traditional accounts. So these are things like a traditional IRA or maybe a workplace 401k or 403b. They allow you to make pre-tax contributions. That means you can deduct traditional IRA contributions from your taxable income for the year, and traditional workplace retirement contributions must be deducted from your paychecks, and so they're going to come out on a pre-tax basis. Putting money into a traditional retirement account is a great way to reduce your tax liability in the current year, so, right now. However, when you withdraw money from a traditional account in retirement, it is subject to ordinary income taxes. Okay, so that's a summary of traditional. Now let's talk about Roth accounts like a Roth IRA or a Roth 401k. With a Roth, you never receive an upfront benefit. You have to contribute money on an after-tax basis. However, withdrawals of Roth contributions and earnings are entirely tax-free in retirement. So that's an incredible benefit. If you get a lot of growth in a Roth account, you're going to get a huge tax savings because it never gets taxed. That's very different from a traditional account where taxes on your contributions and earnings are just deferred until you make a distribution. They don't go away, but they eventually catch up with you when you have to make a distribution in retirement. Therefore, whether you should choose a traditional or a Roth retirement account depends on how much you want a tax deduction in the current year for your contributions. In general, Roth contributions make sense if you believe your income or your tax rate will be higher in the future when you take withdrawals. The idea is that it's just better to pay less tax today than to wait and pay more tax later on traditional withdrawals. In addition, most people really like the idea of having some tax-free income in retirement. Having both taxable and tax-free pots of money to pull from gives you a lot of flexibility that can improve your tax-saving strategy. However, if you're a high earner or you believe your tax or your income will be lower in retirement, deferring taxes with traditional contributions may be best. Paying a potentially lower tax on future withdrawals could save money compared to paying higher taxes today on Roth contributions. But for most of us, we're really unsure about what our future holds. We don't know what our future income or tax rate will be. So in a lot of cases, a split strategy of using both traditional and Roth accounts is wise. So let's talk about the Roth rules for workplace retirement plans. Employers that offer a retirement plan, like a 401k or a 403b, allow you to choose a traditional pre tax account, a post tax Roth account, or a combination of both. For 2026, most workplace plans have a contribution limit of $24,500 if you're under 50. Now, if you're over 50, you can add an $8,000 catch up contribution for a total contribution of $32,500. And if you're between 60 and 63, you qualify for a higher super catch up contribution of $11,250, bringing your total allowable employee contribution to $35,750. Workplace retirement plans typically impose a 10% penalty if you withdraw funds before 59 and a half. However, if you decide to leave your company for any reason after age 55, you can avoid the penalty. So this is known as the Rule of 55. And so it applies to traditional or Roth accounts. While a 401k is available to private sector companies, a 403b is only for tax-exempt organizations. So if you work for a public school, a state university, a hospital, or a church, you may have a 403b instead, and they certainly also offer a Roth option. If your employer offers both plans, so they give you both a 401k and a 403b, you can use both of them if your total contribution doesn't exceed those annual limits that I just reviewed. All right, now let's talk about the IRA. The IRA, or individual retirement account, is available to anyone with earned income or even to a non-working spouse whose partner has earned income as long as you file taxes jointly. While traditional IRAs have no income limits, high earners cannot contribute directly to a Roth IRA. So let me go through what that limit is. You have a modified adjusted gross income, or MAGI, limit in order to make a Roth IRA contribution. So let me go through what those limits are for 2026. If you're a single filer, you can make a full contribution if your MAGI is under $153,000, and your contribution limit gets reduced as your income rises above that point, and you become entirely ineligible for a Roth IRA if you're a single filer with income at $168,000 or above. And if you're married filing jointly, you can make a full Roth IRA contribution if your household MAGI is under $242,000, and then it phases out entirely once you're earning above $252,000. For 2026, the IRA contribution limit is much lower. It's just $7,500 or $8,600 if you're over 50. You can contribute to both a traditional and a Roth IRA as long as your total contributions don't exceed the limit. For instance, if you're under 50, you could contribute $2,500 to a traditional IRA and $5,000 to a Roth IRA, or in any proportion that you like. You can max out both a workplace retirement plan and an IRA in the same year. However, some or all of your traditional IRA contributions may not be tax deductible when you or a spouse participates in a retirement plan at work. But there is no conflict with a Roth IRA. You can max out a retirement plan at work, either traditional or Roth, and a Roth IRA if you qualify for one in the same year. As I mentioned, workplace Roth accounts and a Roth IRA have different rules. So we're going to go through 8 key differences that you should know. Number 1, there are different eligibility requirements. Qualifying for a workplace retirement plan depends on what your employer offers. For example, your company may not offer a retirement benefit, or it may offer a 401k after you've been employed for a certain amount of time. With an IRA, you qualify based on your earned income, and that's the fact no matter your age. However, there is an exception known as a spousal IRA, which I mentioned, where you can make IRA contributions based on a spouse's income when you file a joint tax return. And as I mentioned, having earned income above certain annual thresholds makes you ineligible to contribute to a Roth IRA. You can keep an existing Roth IRA and enjoy its tax-free growth and future withdrawals, but you just can't make any new contributions to a Roth IRA when you earn above the income limit for your tax filing status. Okay, the second difference is there are different annual contribution limits. I reviewed them, and you'll remember that they are much higher for workplace retirement plans than for IRAs. Again, for 2026, workplace plans allow you to contribute anywhere from $24,500 to $35,750, depending on your age. And IRAs allow contributions from $7,500 up to $8,600, again, depending on your age. Number 3, you might receive workplace matching. So, workplace plans can offer matching funds to participating workers if the employer allows it. Now, that's an excellent benefit to enjoy, and you should always maximize it when possible. For instance, your company might match 50% of your contributions up to 6% of your salary, something like that. Now, in the past, matching funds that a company paid you had to be contributed on a pre-tax basis to a traditional account. But now employers can deposit matching contributions into your Roth account as taxable income. All right, the fourth difference is there are different income limits. Workplace retirement plans don't have any minimum or maximum income restrictions to participate. Even very high earners can participate in a traditional or a Roth account at work. But to contribute to an IRA, you've got to have earned income equal to or exceeding your contribution. For instance, if you're a teen with a summer job and you earn $4,000, your maximum IRA contribution would be $4,000. But if you earn $10,000, you can contribute up to an IRA account maximum, which is $7,500 for 2026. As I previously mentioned, there is an income limit to qualify for direct Roth IRA contributions. However, no matter your income, you can move money from a traditional retirement account into a Roth IRA and pay tax on those amounts. That's a strategy called a Roth conversion. So doing one or more Roth conversions is an excellent way to boost your Roth balances indirectly. However, be sure you have ample savings because you're going to have a larger than normal tax bill. Those amounts that you move from traditional accounts into a Roth have to be taxed in the year you move them. All right, number 5, you might qualify for workplace loans. Many workplace retirement plans allow you to borrow money from yourself, and there is a limit. It's up to 50% of your vested balance for a maximum of $50,000. But IRAs never permit loans. Taking a 401k or 403b loan means you have to repay yourself with interest, typically within 5 years, through payroll deductions. While that helps you make up for lost time, missing a repayment is the same as taking an early withdrawal, which is subject to a 10% penalty and taxes on amounts not previously taxed. So if you leave your job or you get terminated, you typically must repay the outstanding balance of a workplace retirement loan by your tax filing deadline. So it's a benefit to carefully consider before using. Number 6, you have different investment options. With a workplace retirement plan, you're limited to the investment menu that your employer offers. However, for average investors, that's not a downside that should keep you from participating. Workplace plans have many benefits, including those high contribution limits I reviewed and potential employer matching. IRAs typically offer the widest range of available investment options, including stocks, mutual funds, exchange-traded funds, cryptocurrencies, and a lot more. There are even self-directed IRAs that allow you to invest in physical assets like real estate and businesses. Okay, number 7, there are different withdrawal rules. Workplace retirement plans qualify for the Rule of 55, which I mentioned allows you to tap the account penalty-free if you leave your job at age 55 or older. IRAs do not allow this rule. So, one unique benefit of a Roth IRA is that you can withdraw contributions, but not the earnings, tax and penalty free anytime. But that's not the case with a Roth at work. Workplace Roth contributions cannot be isolated, so early withdrawals must be taken proportionally from contributions and earnings, and that makes workplace Roth withdrawals prone to taxes and penalties unless you qualify for an exemption. In addition, to access your workplace retirement account in the first place, you typically must prove a hardship that poses an immediate financial need, something like unreimbursed medical bills, maybe preventing a home eviction or having tuition bills. Some plans may allow you to withdraw up to $1,000 per year for a personal emergency or to take a limited amount of loans, as I previously explained. If you want maximum liquidity for emergency access before reaching 59 and a half, a Roth IRA is far superior to a workplace Roth. And once you've owned a Roth IRA for 5 years or reach 59 and a half, you can make tax-free withdrawals. Unlike traditional retirement accounts, workplace Roths and Roth IRAs have no required minimum distributions or RMDs. So that means you can spend them or pass them on to your heirs entirely tax-free. Number 8, there are different catch-up rules. New legislation in the Secure 2.0 Act requires high earners who are over 50 to make catch-up contributions to a workplace Roth. And this applies if your prior year FICA wages exceeded $150,000. Again, this mandatory Roth rule only applies to workplace plans. It does not apply to a Roth IRA. So if you're over 50 and you've got earned income, you can direct your $1,100 catch-up contribution to either a traditional or a Roth IRA, of course, if you qualify for a Roth, up to the 2026 annual limit of $8,600. All right, that is a ton of information and numbers that I just threw at you. If you have any questions about retirement accounts, I would love to hear them. You can visit lauradadams.com and use the contact page there to send me your question or comment. And as always, I would love to hear it. I can include your question in a future edition of Finance Friday. That's our Q&A bonus edition of the show. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a Quick and Dirty Tips podcast. We've got an excellent team. I want to thank Steve Rickyberg, our audio engineer. Holly Hutchins is our director of podcast. Morgan Christensen is our manager of creative partnerships and business development. Rebecca Sebastian is our marketing and publicity manager. Nathaniel Hoops is our marketing contractor. And Maram El Naguib is our podcast associate.